So, you want to start investing, right? But let's be honest, it can feel like you're staring at this giant, confusing map with absolutely no directions. Well, what if you had a clear, step-by-step guide to build your very first investment plan? In this explainer, we're going to do just that. We're going to turn that confusion into confidence and give you the compass you need to get started.
And this is the million-dollar question, isn't it? Where do I even start? You hear all this jargon, you see a million different options, and it's just so easy to feel completely overwhelmed before you even put a single dollar in. A lot of people get stuck right here, but that's not going to be you.
Don't you worry, we are going to break this whole thing down into simple, manageable steps. We're going to use a straightforward framework that anyone, and I mean anyone, can follow to create a plan that's right for them. Ready to dive in? Let's go.
Okay, first things first. Before you even think about investing, we need to make sure your financial foundation is rock solid. Now, this isn't the flashy, exciting part, but trust me, it is the most important part. This is the bedrock for everything else we're going to build. All right, let's get real about priorities. Having a stable income is fantastic, but those first 3 things on the list, they're non-negotiable. Seriously, without an emergency fund, without insurance, one bad day, a medical issue, a job loss, could force you to sell your investments at the absolute worst time. Think of these as your financial safety net. You just don't invest without one.
So, once that foundation is set, the next big question is how you're actually going to put your money into the market. Are you going to go all in with a big chunk of cash at once, or are you going to invest little by little, nice and steady?
A lump sum investment, well, it's exactly what it sounds like. You invest a big lump sum of money all at once. The biggest risk here is timing. What if you invest right before the market takes a dip? Oof, that can be tough. Now, a systematic investment plan, or SIP, is the perfect answer to that problem. By investing a fixed amount every month, you automatically buy more when prices are low and less when they're high. It's called dollar-cost averaging, and it is a beginner's absolute best friend because it takes all the stress and guesswork out of the equation.
And this right here, this quote says it all. It is the core philosophy of smart, long-term investing. Trying to perfectly time the market, it's a game you're probably not going to win. The real power, the real magic comes from just being in the market consistently over a long, long time.
So here's the bottom line. For building wealth in a disciplined way and for sleeping well at night, this systematic approach is absolutely the way to go. It makes investing a simple, automatic habit, not a series of high-stakes, stressful decisions.
Okay, now for the main event. It's time to design your personal investment portfolio. This is where we figure out exactly what you'll be investing in. This is where the fun really begins.
You know, a portfolio isn't something you just buy off the shelf. It's a collection of different investments that you put together. Think of yourself as the general manager of a sports team. Each player, your stocks, your gold, your debt funds, they all have a very specific role to play to help you win your financial game.
And here's our game plan for building that winning team. We're going to walk through these 5 simple steps to create a portfolio that is tailor-made for you. It all starts with you, your goals, your comfort with risk. Then we'll get into the nitty-gritty of asset allocation and returns. See that last step, number 5? Choosing the actual products? That comes dead last, only after we have our entire strategy locked in.
Okay, listen up. If you only remember one thing from this whole explainer, let it be this. Asset allocation is everything. It's simply how you split your money up between different types of investments. And get this, it's responsible for the vast majority of how your portfolio performs over the long run. It's that important.
So let's see what this looks like in the real world. For someone who really values safety and doesn't want a lot of drama, a conservative portfolio is perfect. See how most of the money, 60%, is in debt? That's stuff that's generally more stable. Then you have a smaller piece of the pie dedicated to growth through equities or stocks.
Next up, we've got a more balanced approach. This is for the person who wants solid growth, but also wants a nice cushion for when the market gets a little bumpy. It's a really nice mix of growth assets and stability assets.
And finally, for the person who's in it for the long haul, we're talking 10, 15, 20 years or more, there's the aggressive portfolio. This person is comfortable with the market's ups and downs because they're chasing higher potential returns. And you can see here, equity is the star player, making up a huge 75% of the team.
All right, so we know what to invest in, and we know how to do it. Now for the big one. How much money do you actually need to invest every single month to hit those big life goals?
You know, abstract numbers can make your head spin, so let's make this real. I want to introduce you to someone. This is Faisal. He's going to help us walk through exactly how to calculate the numbers for your own plan.
So Faisal is 30 years old. He's at the perfect point to start building his financial future, and he's ready to go.
And he's got a really clear, long-term goal. He wants to be able to retire in 25 years at age 55 and just enjoy life.
Now this part is so important, and it's something a lot of people miss. We can't just plan for today's prices. We have to account for inflation, the fact that everything gets more expensive over time. So the amount Faisal will actually need in 25 years is way higher than what he'd need today. You have to do this step or you risk falling short.
So after all the math, this is his target range for his monthly investment. Now, he could just invest a flat 22,000 rupees a month. Or, and this is a great little trick, he could start with 16,000 and just commit to increasing that amount a little bit each year as his salary goes up. We call that a step-up SIP. And it makes getting started feel so much more achievable.
All right, so your plan is built, your automatic investments are running. You're done, right? Well, not quite. Investing is kind of like gardening. You can't just plant the seeds and walk away. It needs a little bit of care to really thrive. The good news, it's a simple check-in you only need to do about once a year.
Think of this as your annual financial checkup. First, you look at your goals. Are they the same? Next, your income. Can you maybe invest a little more? Then the big one, rebalancing. Let's say stocks had an amazing year. Your portfolio might have drifted to 80% equity. Rebalancing just means you sell a bit of that winner and buy some of the underperformer to get back to your 75% target. It's a super disciplined way to force yourself to sell high and buy low. And finally, you just make sure the funds you picked are still doing a good job for you.
We've covered the whole journey, from making sure you're ready, to building the plan, to keeping it on track. The entire playbook is right here. The path is clear. So now, the only question left is what is the very first step you are going to take to build your own financial future.